Hello and welcome to Macro Mondays. This episode was recorded on Friday the 1st of November. I'm James Todd, Direct Trader here at Onyx Commodities, giving you insight from our trading floor.
And I'm Will Cunliffe, a Research Analyst here at Onyx.
In today's episode, as with every episode, we'll be looking at some of the key market data, charts and risks, and we'll be looking ahead to a huge week of data right before the US presidential election next week.
We've had a fairly tough run of data today. US payrolls and PMIs disappointed, so we'll be discussing those. And we've started to see signs of the Trump trade potentially unwinding.
Yeah, so highlights on today's show will be the overnight Brent move that we saw on Thursday evening, growing risk of geopolitical tensions in the Middle East. As Will mentioned, the US payroll data, the S&P 500 and gold are both coming off. Is the Trump trade unwinding, or is it too much to read into that? And we'll be analysing the US election, looking into the week ahead.
The data, as we suggested, was mixed, so we're going to be discussing where does that leave the Fed and what can we read into that. Chinese data is also coming a little bit stronger, so we'll be discussing that too, alongside other data from Asia.
So yeah, to start, let's just talk briefly about the US data that's come in this week. We actually saw a bit of a mixed picture. We saw the PCE print down to 2.1%, which was in line with expectations, and core PCE was also at 2.7%, in line with July and August levels. So these indicators are probably slightly reassuring to inflationary fears, and indicates that inflationary pressure could be abating. Consumer confidence, the CB Consumer Confidence Index jumped to 108.7. This is the highest level that we've seen since January 2024. So off the back of those positive bits of data, one might think that everything in the US is hunky-dory, but no. The non-farm payrolls came out today, and this was a really disappointing set of results, wasn't it?
Yeah, big downward surprise. So markets were expecting about 113,000 jobs added, but instead we only got 12,000 jobs added in October. And the market was quick to kind of try to interpret this. A lot of people pointed to the hurricane, a lot of people pointed to the strikes at Boeing, for example, and it would appear that those have indeed weighed a lot on that headline reading. And obviously this is very important for the Fed. They're going to be following that very closely now that PCE data has become kind of a secondary input into that Fed reaction function. But the unemployment rate was maintained at 4.1%.
Yeah, absolutely. I think one of the things though that is important to look at is this revision down. One of the criticisms from, especially from Republican-leaning media outlets of previous non-farm payrolls was that these numbers are not real. And what we have seen is a revision down of the August and September non-farm payrolls. So the August non-farm payroll was revised down 81,000 jobs, and the September non-farm payroll was revised down 31,000 jobs. Coming into this election, this is a very important thing. Optimism around unemployment. Whilst unemployment remains at historically reasonable levels, having this data misrepresented for the previous, essentially, 3 months, I think would be worrying to many of the median voter in the US.
Yeah, and I mean the data revisions seem to be a pretty systematic issue at the BLS. That throughout this year, it's very rare that the back data revisions are minimal.
Yeah. And then also looking at the PMIs from the US, what did we see there?
So PMIs plunged deeper into contraction. So we had manufacturing PMIs print at 46.5 for October. That was far below last month's 47.2, and a big downside surprise to consensus estimates of 47.6. PMI data is always a little bit choppy. It's a survey, so read into it how you wish. And it's also important to bear in mind that manufacturing now only contributes around 10% of US GDP.
Absolutely.
But nevertheless, further contraction can only be a bad thing, especially in those heavily industrial swing states.
Yeah, it might be the case of putting 2 and 2 together and getting 5, seeing this non-farm payroll data come out worse than expected, and also looking at these PMIs and, fearing the absolute worst. But it definitely doesn't paint a fantastic picture for the US. And what was the market's reaction to this?
Yeah, so the market reacted pretty violently to the data. So we had an immediate repricing of treasuries. Yields on the 2-year treasury shed 10 basis points, and that was kind of consistent across all tenors. It would seem that markets are pricing further cuts from the Fed, effectively. Ahead of the print, the OIS was pricing around 19 bips at the next meeting, but as soon as shortly after the print, the OIS repriced at 21 bips.
Yeah. No, and I think it makes sense as well. This was one of the things that had forced the Fed's hand previously in terms of cutting rates. And even though the bottom line unemployment rate hasn't increased, I think people will be starting to worry that will creep up and up. And so will the Fed be reactive or proactive in terms of cutting rates? Either way, it does seem that rate cuts in the future are going to be instigated.
Yeah, for sure. And I think as well, one interesting development that we've all been following has been the recent rally in yields and the recent bear steepening in the Treasury's curve. A lot of people have kind of pinned that on the Trump trade. You buy gold, sell Treasuries. Trump will be inflationary. But what's interesting is actually if you decompose that yield. So if you look into what's driving the rally in yields, it's more of a real yield story than it is an inflation expectation story. Measures of inflation expectations from the market, whether that's 5-year inflation swaps or your 5-year break-evens, 10-year break-evens, they've really not moved that much over the last month, but yet we've seen yields drive higher. So with inflation well anchored and coming down towards target, that definitely gives the Fed some wiggle room in policy. And these weaker labour prints are definitely going to enable more easing.
Yeah, and then I think we'll move on briefly to talk about US corporate spreads. So we saw the ICE Bank of America high yield OAS spreads. They're at their smallest level since 2005. So what's the significance and what's the context of this?
Yeah, so this is really interesting. So what this indicates is that rise in yields hasn't passed through as much to the real economy as we might have expected. Markets are not pricing default risk in corporates in line with where they have pre-pandemic, whether that's just a high treasury yield story or whether that's actually a real change in sentiment towards corporate funding conditions. It's not clear, but it's definitely more accommodative than we would have thought.
Absolutely, and I think this statistic is quite a good demonstration of it because this takes a volume-weighted average, right? Mm-hmm. And so if you're looking for the impact not just on the headline risk but on the infiltrated bonds throughout, then this tells quite a good story, I think.
Yeah, for sure.
Fantastic. And then let's you mentioned the Trump trade unwinding a bit. We've definitely we've seen signs of it. Gold is off 1.6% this week. Nasdaq down 2.8%. So this is the worst drop in gold since July 19th this year. $9.53 billion wiped from the US stock market as well with the Nasdaq story. So what can we read into this? Is this a story of I have seen headlines about earnings worries from the likes of Apple, etc.
Yeah.
Is it this, or is it speculators pushing things down?
Well, I think it's a bit of both potentially. I mean, the Apple story was an interesting one because they beat revenue expectations, but concerns about Chinese demand really weighed on the equity price. So part of it is probably the earnings, but what's also been very interesting is with yields at this level, the opportunity cost of not being in treasuries has increased, right?
Yeah.
So we had a huge short position in US treasuries, like record short in money managers, and then as I'm sure you talk about a lot in what you do, if the market gets massively positioned one way, the ability for it to come back is greater, right? So you see a lot of people buying back those shorts. So that's kind of incentivizing that rotation back towards.
Yeah, absolutely.
Treasuries.
And I think, building upon what you said in terms of the trade craft of many of these people, if you've been short equities for the past 6 months or whatever, you're probably going to have had to have stopped out of your position to sort of put what you've said in layman's terms. And one of the things that we've discussed on this pod a few times is the underlying US economy doesn't seem to be that super, and yet we've just had amazing equity support throughout this entire time. So if it looks like a bubble and sounds like a bubble, it could be a bubble. Now, I'm not saying that we're not seeing anything Trump related or yada yada yada, but I think when it's easy to skim a bit off the top when we've had such inflated levels, you shouldn't be surprised to see a steep downturn. Whether that trajectory remains down, I'm not sure, but yeah, it's not of huge surprise to me. And then, so building upon this, just looking at the S&P 500, obviously we saw the NASDAQ was down, but that we're coming into earnings seasons. So earnings have been quite mixed amongst especially some of the larger companies and tech-focused companies.
Yeah, for sure. I mean, Amazon and Tesla reported really quite strong earnings, but then Microsoft disappointed massively. And, when the bar is that high, expectations are always really, really, really strong. So surprising to the upside becomes more and more difficult.
Yeah. And I think also the market digests this information in an interesting way, right? Microsoft and Apple, they're two companies that have looked to consume some smaller AI companies and really be at the cutting edge of the AI revolution. With earnings not looking fantastic, it's understandable that people are a bit skeptical. And even the Tesla story, them surpassing expectations. Yes, they surpassed it, but contextualize it. So BYD, I believe BYD revenue exceeded quarterly revenue for Tesla for the first time ever. So whilst the picture domestically might look good for Tesla, especially if we're going to be moving into a high tariff environment, if we're in a sort of your more free market Ricardian trade model thing, Tesla beating earnings in context may not be the silver lining that everyone had been hoping for.
For sure.
And yeah, as we mentioned, we spoke about a bit briefly here, gold has come off. It's one of those as well where I suppose inflation worries were one of the major reasons why gold was finding support.
Yeah.
And if you're not as worried about inflation, perhaps you're not as fussed by gold.
Yeah, I mean, gold was an interesting one because we saw the inflationary picture and that argument driving flow, but then also there was a lot of central bank buying. So Poland, India for a while as well were scooping up huge amounts of gold, and that was really driving the price. So then you had a bunch of macro funds following that and dumping in. That can only go on for so long.
Yeah.
It's not really surprising that we're seeing it come off from its all-time highs.
Yeah, and I think the central bank narrative is, it's one to follow because I think Poland and some other central banks did fantastically well out of buying a good amount of gold. But as you say, there's only so much that you can do. And I think coming into what is a very big US election with a lot of political uncertainty around, and there's always whispers of the petrodollar, the hegemony of the US dollar over oil transactions coming under scrutiny. With uncertainty over the political future of the US, you might see more running to safe havens like gold. But if it looks more decisive one way or another, then perhaps you're not going to be seeing as much, hot money flying into gold, I would say.
Yeah.
And then, just to quickly talk about Brent. So last night we saw, so this being Thursday evening, what will be last week, Brent rallied significantly, post-expiry as well, might I note. So after the 6:30 Brent expiry at 6:30 London time, Brent rallied 1.5% over a dollar and a bit, $1.10 or so, on the headline that, quote unquote, Iran are preparing for major retaliatory strike from Iraq within days. So this was reported by Axios, who had been at the forefront of some of the other Iran-Israel conflict headlines recently. We saw a significant spike. It's understandable why we saw this spike. If Iran are to strike Israel, then you might expect more tit for tat. Iran, big oil-producing country. So we did see this significant rally almost immediately. And it's one of those things that we've said before, you can look at the underlying, but sometimes the headline will drive things. Mm-hmm. What's quite interesting to my mind is that things didn't soften immediately. They've been a bit more gradual. And, today we saw a bit of a rapprochement headline from Reuters saying Iran will respond at the appropriate time and in the appropriate manner. So this was a far cry from the headline last night that was almost insinuating that Iran was going to strike, and there was talk as well about Iran striking pre-presidential election. So immediately everyone flocks and buys crude, but it might just be one of those examples of buying the headline and that not serving you right. But
yeah, and I mean we've seen this on numerous occasions, right? In recent history, there's been a headline that's come out and oil's jumped, and then it's turned out to be nothing, and then retracement issues. We'll stay tuned to see how this one plays out.
I think what we will likely see, though, given ongoing geopolitical headlines, you have so many at the moment with what's going on in the Middle East, but also what's going on in Russia and Ukraine, with North Korean troops being reported to being pulled in and fighting for the Russians against the Ukrainians. With that, and crucially with the presidential election coming up, we were talking for a bit about, are we going to be exiting our low volatility period in oil? And I would not be surprised if we see some breakouts. It can't just keep converging like this. And a breakout like this to the upside does seem to be more than a flip of a coin's worth of happening.
Definitely.
And then, just to talk about the Chinese economy quickly. Do you want to introduce us here, Will?
Yeah, for sure. So we've had two sets of PMIs come out from China. We had MBS PMIs earlier in the week, and today we got Caixin manufacturing PMIs. On the manufacturing side, they both printed expansionary, so reversing the contraction we've seen over the last few months from Chinese manufacturing PMIs. The official NBS PMI was the first expansion since April, and Caixin was the strongest since June. But within the Caixin measure, there was still some underlying weakness. So the employment sub-index fell by the most in 18 months. That it just goes to show the fiscal stimulus really is falling short in China. There's some discussion that maybe they're holding off until the election in case Trump gets in. Then they have some ammo in reserve, effectively. But who knows what they can do there. The difficulty with China is that they have such a high savings rate. So, the circular flow of income, savings are withdrawal from that. So if you can't invoke people to spend, then the stimulus will always struggle.
Absolutely. And building upon what we'd said about gold, the Chinese were very good buyers of gold. The stimulus package, I think it would be a far cry to say it has failed, but it hasn't been 100% passed through and supported.
No.
I suppose, yes, it's promising to see these PMIs flipping back slightly positive.
Yeah.
But it's worth noting as well with these things that they're a moving average.
Yeah.
So whilst it could be a sign of the ship turning a bit, it doesn't say that the Chinese economy is suddenly in a great position.
Yeah, and if you've had multiple consecutive months of contraction, 1 month of expansion, is that really any good news?
Correct. So I think that's the right take on this. And then Japanese production as well. We're not seeing everything being fantastic in the long run there, but signs of improvement.
Yeah, signs of improvement. I think Japan have been struggling with the industrial picture for a while, especially with China being able to effectively flood the market. Their marginal costs are just, no one can compete with it. So over 18% of Japanese exports of vehicles, for example. And that sector is really, really struggling. Toyota's production fell 8.3% year on year in September. Mitsubishi fell 10.4%, and Honda fell 20%. And that left the headline industrial production contracting by 2.8% year on year, despite that 1.4% month on month gain.
Yeah.
But yeah, no one can compete with China, and we're seeing that in BYD's earnings, as you said earlier.
Yeah, and it'll be interesting to see, what Japanese industrial production is like in the months to come, because obviously Japan has been sort of, I suppose, the bastion of low interest rates. In theory, cheaper borrowing on that front. Now, if they're going to be increasing interest rates, is that going to be having a negative effect and damaging industrial production in the future?
Exactly.
It's possible, but I would have thought, particularly in the auto industry, that's going to be significant. There's so much money that's needing to be spent on capital in these sorts of things. You have to raise this money, and a higher interest rate makes that less economical. So, it might be the last time to buy your Mitsubishi 4x4. But,
potentially.
And then, let's flip over quickly to Europe. So I think on this pod, it's fair to say we've been relatively bearish, well, just outright condemning European macro performance over the past few months or so. Are we seeing anything different here?
I mean, it's more of the same, really. Germany is looking pretty dire. France is looking potentially a little bit better. We've seen some better data prints out of there. But today we got headline inflation in the euro area, and that printed at 2% in October, up from 1.7% in September. And, reading into this, is this a demand story? Probably not. This looks like more of an energy base effect story. So we're starting to see the energy price that was a lot more elevated last year. The base effect is starting to pass through and drop out of that headline figure. We've seen services inflation, however, remain elevated at 3.9%, and that's something that the ECB is following very closely. They've long been for a long time communicating, services inflation is the big worry there.
Yeah, and I think that's understandable given a lot of these economies are quite advanced consumer economies, and services make up a significant proportion of their industry overall. It would be worthwhile looking at Germany, and they, similarly to Japan, I think VW's had a particularly dire set of earnings recently. But yeah, you're absolutely right with this inflation story. We had energy prices really contributing to inflation, almost too much so. It got seemingly uncontrollable. But now, this word stagflation, it's worrying because productivity doesn't seem to be higher. It seems to be dwindling. We'll talk about PMIs till the cows come home. But the bottom line is that major industry in Europe doesn't seem to be doing that well. And demand just doesn't seem to be there. Now, let's turn our eyes to the US election quickly. So this week we've seen, we had an initial widening of the betting odds in favor of Trump. It's converged slightly. I think,
a little, it has. It's come in a little bit, but Trump still commands a pretty strong lead over Harris. I think it's fair to say in the betting odds.
Yeah, and I guess the question is it garbage to look at the betting odds as opposed to polls? What's the significance of the betting odds widening versus the polling data?
Yeah, and I mean, I think a few weeks ago, even polymarket poll odds, for example, liquidity was pretty low in the in those indexes. Whereas now liquidity is much higher. So you'd think that that's potentially a little bit more representative, and you can't have big players coming in, taking a huge position, swaying the odds. But there's always a risk of that.
Yeah, I'm a bit dubious about this being truly representative, and I'm not going to say that the polling data is going to be accurate or fantastic, but I think it might be a touch better in this scenario because ultimately this betting on US elections is a new thing to the US. It was only made legal for this election, and what we're going to be seeing is who are the people that are putting money on this. If you're swinging things, if you're a guy sat in your basement putting, $1 million of Bitcoin earnings that you've made throughout your career on this election, you're still only one voter, and the accessibility of online betting on politics is really limited, right? You're not getting your 85-year-old granny who can't work a phone betting on this. Mm-hmm. So I think it's more important to be looking at who's turning out for polls and who's putting money on in the betting exchange. And I saw one of the polls the other day was saying of voters who had actually turned out in the 2016 and 2020 elections, it was pretty much 50-50, if not 51-49 to Kamala. So if we're going to be giving that more credence, which I think it sounds like a reasonable thing, it's definitely going to be a dead heat going into this.
But then it's also, has Trump been able to mobilize the politically inactive? And will we see more people come out to vote this year than we have in the past? Who knows? It'll be very interesting to see what happens on Tuesday, though.
No, absolutely. I think that's a very good point.
Will you be staying up to watch it?
I'll be trying, and then I'm sure I'll fall asleep at some point. But and then so we'll be staying up because we're in London, and in London a lot of eyes have been on the UK budget this week. So we had Rachel Reeves delivering her first Labour budget in 14 years, and it was met with mixed response. A lot of people saying, "Oh, not as bad as it could be," having I think feared the worst. But the market certainly reacted, I think, as a lot of the population did.
Yeah, I mean, I think. What was interesting with the budget this time that I've seen, the initial response, like you said, was pretty good. I think the market reacted pretty favourably. But then the Treasury came out and said how they were going to actually fund the extra spending on the NHS, and all of a sudden there's a £35 billion black hole that needs to be filled somehow, and it means more debt. So then there was a bit of a retracement. But yeah, for the most part, I think the broader narrative in the media has been very good.
Yeah. Just to rattle through a few of the headlines here. So capital gains tax increased from 20 to 24%. There had been rumours before of 39%, which I think was a bit doomsdayish even by some speculators' points of view. And then employers, so there was no national insurance increase for employees, but that burden was to be is going to be borne by businesses. So we saw employer national insurance increased from 13.8% to 15%. There was an increase in energy profits levies, and there was a freeze on the tax increase on petrol. Private jets weren't so lucky though. There was an increase in private jets taxing. But I think one of the things that, as we had discussed before the podcast, the rhetoric around this budget had very much implied and made clear that this was not going to be an easy budget, and we weren't going to be laughing and jumping around. That this is a budget to try and turn things around.
For sure. There was a lot of damage control done ahead of the budget. A lot of leaking going on, which I think Reeves got in a bit of trouble for. But yeah, they just didn't want a repeat of what happened with the Truss government, right? With Kwarteng's mini budget that ended in disaster and the Bank of England having to step in and buy gilts at breakneck pace. And by the looks of things, they were successful, right?
Well, it certainly hasn't been as bad in terms of a gilt response as Liz Truss's mini budget, as it turned out to be. Gilts did rise, but far less so than in years prior.
Initially, they sold off, but then when the Treasury came out to say they were going to borrow more, then they rallied a little bit more. Yeah.
Well, and perfect. Let's now start wrapping up and look at central bank OIS pricing for the next 12 months. So what we see here is the Fed is now forecasting 115 basis points of cuts over the next 12 months. BOJ notably up 35 bips. And Bank of England, we're at 89. So, But yeah, I think that Fed number is definitely one to watch. On the back of payrolls data, etc. If unemployment is seen to be creeping up, we might be expecting quite significant rate cuts there.
So do you have any predictions for the meeting next week?
I reckon 25 seems to be a bit of a dead cert. The difference between 19 and 21. It's not all that significant, but I wouldn't be that surprised if they kept it flat as well. I think it's going to be politically nuanced, whatever their next move is. So maybe they'll wait for the dust to settle a little bit. And now on to some of our key data releases to watch over the coming week. So on Monday, we'll be looking at the Euro area manufacturing PMIs and US factory orders. Tuesday, we get the China Caixin Services Composite PMI, France Industrial Production, US Trade Balance, ISM Services PMI, and of course, the presidential election.
On Wednesday, we'll get the Euro area HCOB Services and Composite PMIs. And then on Thursday, we'll get obviously the Fed interest rate decision, as well as Spain Industrial Production, China Trade Balance. And then on Friday, we'll wrap up with Italy's industrial production and retail sales.
So yeah, I think the one that stands out there is all of the US stuff on Tuesday with the ISM services and, of course, the presidential election.
Yeah.
So,
and that would be interesting as well, of course, because we've seen that divergence in the US between manufacturing and services. I know manufacturing is a much smaller part of the economy, but services have been really outperforming. But today in the NFPs, we lost over 40k jobs in services, and so that will be an interesting one to keep an eye on.
No, absolutely. Well, thank you very much for listening this week, and we will join you again next week.